What's your story? Whether you're a client or an independent financial advisor, we know you face many important decisions that can affect your and your clients' long-term financial success. Welcome to the WIN Podcast, What's Important Now with Corey Heimensen, accredited investment fiduciary and president of Heimensen Wealth Advisors. In this podcast, Corey helps you identify your goals and objectives through financial education and comprehensive planning, while inspiring you to make better behavioral decisions in your personal finance. With a twist on pop culture and current events, join us as we explore growth and protection strategies for individuals, advisors, and their businesses. Come and discover what's important to you now.
Hello and welcome to the What's Important Now podcast with your host, Corey Heimensen. Corey, good to be with you again, my friend. How are you?
Bill, I'm good. It's amazing how fast, I was going to say a few weeks go by, but days, weeks, hours, months.
Everything goes fast. Everything goes fast. Are you serious? It's like, good grief. It's like everything's on super speed motion or something. You have a really fascinating topic today. And I say it that way because I think there are a lot of people who do not understand the difference between the two things you are going to talk about today.
Yeah, and just to make people, sit on the edge of their chair a little longer, I'll say this, that in life, I think you need to understand things to really appreciate them and get better outcomes, possibly.
Sure.
And so maybe we can, go down that path and educate people today and, dial this in and help improve things. The words we're talking about are risk and exposure.
Which a lot of people think are the same thing, Corey.
Yeah, and they really are not. One is really more important to focus on than the other. And so we're going to title this, just because we have to have a fun title, the editor tells me, Under the Hood of Risk and Exposure.
I like that. That works.
So there you go. We're at episode 54, and we're getting under the hood. Here we go. And so I say that, a lot of people or investors, they focus on the wrong word. And which word is that? Risk. It's obviously risk. Yeah. That's just an easier word for people to associate with maybe, or have a quick mental picture of what that means.
Well, yeah. And the phrase you hear all the time is, what's the risk reward? It's impossible to get away from that, right?
Yeah, no, that's exactly right. You talk Wall Street, you talk investing, it's risk and reward, it's fear and greed. It's all these words that are like trophies or scarlet letters. It depends which way you want to look at it, I suppose, right?
Exactly.
Can a word
like
be a scarlet letter? That doesn't
chest.
make any sense. I don't know. But, what's risk? I mean, at a real basic level, I think risk is just, what's the possibility of something bad happening? What's my downside?
That's life.
I joke with people that I could get hit by the crosstown bus coming to work, and then they tell me that I live in a small community in Iowa that doesn't have a bus system.
No, it's true.
So I mean, but there's points to that. I mean, bad things happen to good people all the time.
Sadly, they do. Yeah.
And I guess I'm not here to have risk conversation talking about death and disease and all these things. But I mean, essentially risk is risk, whether it's your account value on a statement or whatever you do in life, or we can go so deep.
No, but your basic point is that, is well made, which is to be alive means to incur a certain level of risk, because there are things you just are out of our control.
Yeah, and I'm just thinking out loud. Maybe people focus on investing risk or on things that affect their money, but if you think about risk, it's probably more likely that you'll get in a car accident or dent your fender, or a storm will come and ruin the roof on your house. These aren't necessarily death situations or outcomes, but
right.
Do people evaluate the risk of their car insurance not being enough or their homeowners? You know what I mean? If you want to really lose sleep and focus on risk, you could have a hell of a long list of things to worry about.
Yes. Yes.
But like you're saying too, I don't think that's the way to go through life. So let's try and cap this and understand it, and maybe we can improve something,
So basically, risk is the possibility of something bad happening at any given point, completely out of our control, right?
Yeah, I think risk poses the basic question: what could happen? What's the worst thing that could happen? Or maybe not worst. I mean, what can happen? Just any of these levels. But
yeah,
if we start creeping into the second word, exposure asks, what impact would this have on me? That's the question that is far more important in this risk reward, in this risk exposure balancing act, essentially. Yeah. Because a lot of things that are risky might sound scary on the surface, but is it really that big of a deal to me on the backside, of this event? And so I think that's where people focus too much on risk. Let's go into the exposure thing.
Let's do that, because it's like I'm sitting here thinking about, I'm thinking about this in financial terms. Like, I'm thinking about my portfolio, right? And I'm like thinking, well, okay, I've got a fair amount of risk in my portfolio because I have a portfolio. Really, I'm not sure how to evaluate my exposure. I'm not sure how to understand or measure or quantify that.
Yeah, so we'll focus on the portfolio there. So, and everything comes back to timelines too. So if you're an investor and you're not going to use your retirement account money for 20 years, what's the risk that your account value could go down on paper? That's the famous line. You haven't lost money if you've only saw fluctuation on paper of your statements until you cash it in, But at the end of the day, dollars are dollars. And if it's a smaller number, in theory, it has went down in value. Okay, so you're 20 years away from retirement. You don't need this money for 20 years. What's the risk that the market could go down? Absolutely. Markets go down. I'm not here to say they do not. They go down about 1 out of 4 years. They go down about 3 out of 10. You know what I mean? And you get some sideways ones too. But point being, while that pain might hurt when you open that account statement envelope, what really was the impact on you today? Nothing. If that account went from 50,000 to 30,000, or if it went from 50 to 70, it made no damn difference in the big scheme of your retirement 20 years from now. It almost goes back to the psychological stuff of, if I'm a gambler and I go win $100, you kind of get a shoulder shrug and you think, oh, that was kind of fun. But if you go and lose $100, that hurt far more worse. Is that even a sentence? That hurt far more.
I think so. I understood what you meant, though.
Loss, the exact same movement of money, a loss hurts more than a gain feels good. You know what I mean? And that's a psychological proven thing.
That is so true, yeah.
You find $100 on the street, it's like, yeah, that felt pretty good. You lose 100, and boy, you're going to sweat that for days thinking, how can I be so stupid that I lost $100? So you got to...
Been there, done that, yes.
The gambling or the losing it on the street, which one?
The losing it, the losing it part.
Yeah,
I used to have a friend. Corey, it's a true story. I used to have a friend. He and I'd be walking down the same street, walking side by side each other, and he would go, "Wait," and he'd stop and he'd pick up a $20 bill, and I'd be like, "I'm walking on the same street as you are, and I didn't see that $20 bill." So I've only been able to experience that finding part vicariously, Corey.
It's like playing middle linebacker. You got to have your head on a swivel there, Bill. You got to be aware of your surroundings.
Exactly.
I don't know.
Yeah.
But a lot of this comes back to perspective. Maybe that's the better way to go with this, is that, yes, there's risk. There's risk if you invest. There's risk if you get out of bed in the morning or go jogging on the edge of the highway. I mean, whatever it is, but understand if the worst case is acceptable, if the worst case outcome is acceptable for now, that's okay. Move on, and maybe the way to do this is, let's look at an example. Let's say, okay. it's pretty easy to always have this one. Some country in Europe or the Middle East has a conflict, or they invade another country, and so on the surface, somebody will come in my office and say, oh, this equals World War III, or, they immediately escalate to the worst case scenario. And so while a situation like that might be bad for people over in that part of the world, absolutely, humanitarian thing, it's a bad deal, but if we go to what is the impact on me, if I'm halfway around the globe, the immediate impact is nothing. And I'm not trying to gloss over situations, but I think you follow me. That
I do follow you. Yeah.
The immediate impact is nothing. And so as an advisor or an economist, I think a little further. It's like, well, okay, so maybe this translates into oil production issues. Maybe it translates into the moving of cargo through the seas over there. Eventually there can be economic ripples. But honestly, if that takes 4 months to change the price of gasoline in the United States, chances are it's not going to affect my habits every day of driving or how far I drive.
Right.
So, you connect the dots, and that's what an economist does. Or even a good advisor is just bring things back to reality, dial them back to a perspective you can understand. And then here's the key part. Once you get that resolution or that thought process in your brain, you check it off the list and you move on. You don't dwell on it. Things you can't control, no need to dwell on them.
No, but I want to ask you a question, Corey, because risk is a given. Being alive, taking a breath involves risk. But can you, in a situation like you were just talking about, mitigate or manage your exposure to risk, financially speaking?
Absolutely. Absolutely. And we touched a little bit on insurance earlier. You can buy insurance to insure things that are of value. That's a whole different conversation. I don't want to go there really, but you can definitely mitigate risk, because the problem is people go to work and they stand by the water cooler. And so now if you're anyone under the age of 40 or 30, you probably don't even know what that reference means.
Might be a little dated there, Corey.
Everybody's got a Stanley or whatever these bottles are named that all have a fancy lid and a built-in straw or whatever. You know what I mean? Yeah. But point being, you congregate somewhere at work or on a break, and there's always a coworker who's talking about this or that being so great as an investment or whatever, or vice versa. I hear people that say, oh, Johnny and Susan, they lost lots and lots in their 401k. Well, you don't know their situation. You don't know how they're allocated versus the next person versus you. So, to mitigate risk, that's what you do. You figure out what's the risk at hand, what's the exposure, and then we dial in the portfolio. And it comes back to, like I said, timelines. The money you're investing for 20 years from now absolutely should be a more aggressive, and thus it's going to be more volatile. It's going to move up and down, but more often than not, it'll be in your favor. History tells us. The short-term money, an emergency fund, or your college account for your child or grandchild that's going to college in 2 years, you don't have that in the market in an aggressive way. So
yeah.
That's maybe the problem, is that people hear investing and they just automatically think that everything is scary and aggressive. No, investing in a government bond is still an investment, and it's backed by the full faith and credit quality of the United States government, which I don't think will default on paying you back if you loan them money as part of a bond.
Yeah, it's funny. It's funny you mention that, Corey, because my very first exposure in life to the notion of investing anything was, getting treasury notes from like aunts and uncles. Getting I'm blanking on what it's called.
You got different levels: savings bonds,
U.S. savings bond. Yeah. That was what it was. They gave me a U.S. savings bond. Here, Billy, here's a U.S. savings bond.
And why? Well, let's go deeper. Why did they do that? They did that because generally those interest rates that are paid on a bond are higher than what the bank will pay you in a checking or a savings account. Everything we're talking about in the investment world is meant to beat the bank on fixed interest rates and to outpace inflation. That's what all this stuff is about. That's all it's about. The question then becomes, why doesn't everybody do this? Because that seems so easy, Corey. Because there's volatility. That every so often, the market will go down and it shakes people out. And those that don't educate, or I shouldn't say those that don't understand, there's that word understanding again. If you don't understand the game you're playing, it's damn hard to win. So you better have a good coach that understands that game and how to win.
Well, and that's where somebody like yourself comes into play on this. I mean, for me, that's the value of somebody like the Coreys in the world, right? Because you can come in and sit down and say, I don't understand, or you can come in and say, what is my exposure? Where am I financially? And you can give me a pretty clear understanding, right?
Absolutely. And so the listeners out there that are clients of mine, they understand and they know that a meeting with me is maybe 10% charts and graphs and 90% conversation and the real value that comes into play. You know what I mean?
Yeah.
Having the conversations, connecting the dots, understanding the situation, that's where you win. It's like football. It's X's and O's. It's most of the preparation is what wins that game on Sunday in the NFL. And that's what you need in this too. Life is about preparation and understanding. So by all means, if you don't know how to do it, don't have the time to do it, then you get somebody else on the team. And as I say the word time, I'm getting all excited and talking faster, and everybody can feel this. I know it. The next few podcasts, we're going to focus on that. Time is really the ultimate winning part of this whole formula equation. True wealth isn't that pile of money. It's discretionary time. Oh, there, I blew it. I blew the next 3 episodes, right? But it's true, and we're going to dive a lot deeper into that stuff. But you get me all fired up, Bill, and then I go off the rails.
No, it's fine. It's fine. Nothing wrong with teasing ahead. So folks who are listening to this conversation, get ready. There's some more coming on this.
There you go. And so before we got on the air here today, we were talking and basically I said to you that a lot of the people that come into my office and maybe ask the wrong question, that risk question or about, I'm worried about national debt. I'm worried about invasions in the Middle East. They tend to be on the older side of generations. I don't get 20-year-olds coming in and saying, oh, I don't know if I want to live in this country and work because of the national debt situation.
Yeah.
And so I was in my mind, I was trying to connect, if people age and they get more cynical, or if they get more life experiences, I don't know, but and maybe it's just as simple as when people come into my office, they think they have to talk about something. You know what I mean? That maybe isn't about them.
Yeah.
Because you have to be a little vulnerable to talk about your family tree, what's good or what's bad in your family tree, and generation skipping things and estate things, and you know what I mean. So maybe it's easier for that person or that mind to focus on events rather than ideas. I think that's the old saying, isn't it? Simple minds talk about other people, and average minds talk about events, and great minds think of ideas.
Ooh, I like that.
And I'm not trying to pick on any of those categories, but if you're one of those things, maybe you want to associate with some of the other categories at different times to expand your knowledge base or your understanding of things or your conversations. I like to think I fall into the idea camp, for whatever that's worth.
Well, yeah, I would love to think I fall into the idea camp, but then I realized I haven't had a really good idea in a while. So.
Maybe that's why nobody likes the nightly news. If you think about the nightly news, what do they talk about? They talk about people and they talk about events. In the simple and average categories.
Exactly. That's perfect. Yeah.
Well, we could probably wrap up. I've now offended one whole section of the whole media industry.
We've just wiped out a whole bunch of people here. No, the thing is, as we ramble through this conversation, I do want to go back to the essential point. There are 2 things in investing which people need to be aware of. One is risk and one is exposure. Risk, as we talked about, is Well, you really can't do a whole look. You cannot walk on a high wire across the Grand Canyon. Okay, you don't have to do that. But risk, basically being alive, involves a certain amount of risk. What's really scary, I think, to everybody is the question of exposure. Can I lose everything? Can I lose half of everything? How would I deal with my exposure? And what in the world is this strange thing called exposure? And I think you've done a pretty good job in terms of laying it out and helping people understand they can, in fact, mitigate the risk and manage their exposure. So these scary words, Corey, are actually something they can do something about.
Right. And you're right. It can be as easy as, the typical diversification word. You own a lot of things. But it's interesting. As you started framing that question or that topic, I immediately went back to, this is a common thing I get. So currently, as we speak, a person can invest in a money market fund, and the interest rates are essentially the same or a little bit higher than certificates of deposit.
Right.
And so I'll explain this to clients for that money that's ultra conservative or super conservative. You don't really want any fluctuation. And people will ask, this money market fund, can I lose it all? They'll ask exactly what you just said.
Yeah.
And I'll say, by definition, I will tell you there's potential if, now this is the huge if, essentially for that to happen, the government would have to fail and all the banks would fail. Essentially, because a money market fund is basically buying or investing in very, very short-term overnight loans between all of these things. And so the bigger question, Mr. or Mrs. Client, is this $50,000 CD or money market conversation. We're not even talking about the other $1 million you already have in the market.
Yeah.
You're focusing on this tiny little line item because it was ingrained in your head that, long ago, generations ago, maybe your grandparents or parents went through the Great Depression and they told you only buy CDs. Don't stray off the path. Well, banks can fail too. And there's FDIC.
Yes.
There's FDIC insurance. There's things you can get your money back, but it's going to be a real pain, and it's going to waste. Here's the key one: it's going to waste your time. It's going to take time to go back and fix that or get your money. So, a tiny sliver, small amount of risk is worth it. Sometimes is the point of all that, I guess. But to your point, where my mind was going was people really focus on that, what if I lose it all? And yet, I think the optimistic people or the business-minded people understand that, if I lost it all on this tiny little sliver of my entire net worth, I could go make it back. Now, I'm not trying to make people think, oh my gosh, we should take crazy risks with certain parts of our portfolio and we could lose them all. Very few investments go to complete zero. Let's just go there. There are individual common stocks that go bankrupt and they will go to zero.
Yes, they will. But you know what? Just to be fair and add some perspective into this, is that this is where people who are not familiar with investing need to seek out the services of professional people such as yourself, because there are companies that go bankrupt, and those companies sometimes can be readily identified because they have quarter after quarter of loss. They're carrying a massive amount of debt, and in a time of high interest rates, that debt is going to cost them more. So that, you can identify some companies and say, those are pretty high risk. If you want to take a flyer on them, you can do that, but you don't want your whole portfolio sitting in a company that's got a frightening amount of debt and has quarter after quarter of losses and is telling you we're going to continue to lose money because the business outlook is so right?
Right.
That's different. That's different from looking at a company that has quarter after quarter of profits, that has quarter after quarter of dividends, that has a well-managed amount of debt. So it's a difference in the market, right? You see where I'm going?
Oh yeah. I would go a step further and say the vast majority of the public in our country that buys individual stocks and let's say they have less than $100,000 of net worth.
Right.
A lot of them would be doing it on their own through an online broker. And I guarantee you, they could not pass a very simple quiz if I gave it to them before they started of what is the title of the quarterly filing that each public company has to file with the Securities and Exchange Commission. What is the market capitalization definition? You know, they don't understand any of these things that go into valuating a company or a stock. Companies are valued based on earnings or potential growth of earnings or growth potential. You know what I mean?
Yeah.
You don't buy GameStop at $200 a share just because you read it on the Reddit message boards and then try and figure out, you know, that, or not have an understanding that it's going to 400 unless you realize that that doubles the market capitalization or the implied value of that company, price per share times number of shares in the marketplace. You know, a lot of those things are things people don't know if they're in the deep, I shouldn't say deep, in the shallow end of the pool and don't have an understanding. They're trading on pure speculation, and they don't understand what it would take for a company to be worth $1 trillion instead of $500 billion. You know what I mean? So,
right.
And I see that too. People will say, well, I'm going to sell that stock when it gets to $112 a share. And I'll say, well, that's like 3 times what it is today. Why would you pick that number? Well, that just seems like a good number. You know, they're not tying it to the true underlying value of all the shares added up.
Which is an example of a risk that you can actually manage.
Right.
Mitigating your exposure to potentially losing it.
And to your point, to do it right, if you own individual stocks as an investor, you should be reading all of those quarterly filings that the company puts out that they're required to do. They go over risks, they go over opportunities. It's basically their board minutes and their plans and their financial statements all laid out for you. They have to do that.
Yeah.
And so like you say, if they're having issues and their CPA says this is likely not going to be an ongoing concern for more than the next 12 months, that means bankruptcy, and that means lack of value, and that means, you're in a risky position. But you got to do your homework. And for most people, they don't either know how to do it, or they don't have the time to do it, or they don't have the desire to do it. Then you damn well better have somebody, a firm, or an advisor, or a team of advisors sort of looking out for you, or educating you, or doing all of those things for you.
Yeah, very true. Very true.
So, did I answer the question, or did I just ramble?
No. You answer the question. And I think that we, reached the end of topic A, if you will, the difference in between risk and exposure, and how actually we can manage that in terms of the markets. And it takes us to episode B, which will not be done in this podcast.
There you go. Yeah, I mean, to a certain extent, you have to understand the exposure. We've kind of dug into that a little, and then we go deeper and we say, let's quantify it. Let's compare magnitude of outcomes, and then we consider levels of risk or levels of exposure that are acceptable. And then we dial in a plan.
Yeah. And you're the plan man.
I'm supposed to be a planner, so I got to act like one and wear the hat.
Yes, indeed. I see that hat. It says planner right on top of it.
Oh, there you go.
So where are we going next time? Where are we going in the next episode, Corey?
Yeah, we need to weigh the importance of time to you. What's important to you, and your level of time or understanding of time might be different than the next. And I'll give you this. If we got a minute, I'll give you this. So I was watching the Jason Kelce documentary.
Yeah.
The football player for the Eagles and kind of in the limelight lately. But he made a statement that really stuck with me. And he said something to the effect of, this isn't to the quote, but to the effect of, a lot of people think a successful life is a long life, living to a ripe old age. And his point was, maybe there's more to just being a really good person while you're here and having an impact on the people around you and maybe your city and so forth. And that really is stuck in my head that, you really need to live each day to the fullest for whatever reason might be out there.
And that, ladies and gentlemen, will be coming up in the next episode of What's Important Now with Corey Heimensen. You want to be sure to tune into that one. And I can't wait to have that conversation because as it turns out, Corey, Jason Kelsey and his wife live probably less than an hour away from me. And I'm very familiar with Jason and his contributions to the city of Philadelphia. And and the importance of what we're going to talk about in the next episode. Thanks for this conversation this time around. For people who are listening who are not your clients, who want to get a hold of you, perhaps because they find you talking about some things that interest them, how do they do that, Corey?
Yeah, this following number, you can either text us or you can make a phone call, and we're going to answer it with a live person. So 712-472-3867.
Very good. Thanks, Corey. Hey, this podcast is a fascinating adventure every single time, and I do mean that. For those of you who are subscribers, of course, you know that already. For those of you who have just listened to this episode, I would encourage you to hit the subscribe button. That way, you do not miss another episode of What's Important Now. And in fact, it might even serve as a reminder for you to go back and listen to some prior episodes that you will find very interesting and perhaps even very useful as well. And if you do, we'd ask you that you share it with other people to help get the word about the podcast out. Thank you for taking the time to listen today. I'm sure you enjoyed it. I'm Bill Tucker, and I'm on behalf of everybody at Heimensen Wealth. Thank you for listening, and I'm reminding you, as Corey just mentioned a short moment ago, go out today and make today a great day. It's your choice about whether it's great or not. Thanks for listening.
Thank you for listening to the WIN Podcast, What's Important Now, the show that helps you achieve your financial dreams. To ask questions about topics covered during the show or get a copy of Stop Doing Dumb Things with Your Money by Corey Heimensen, visit www.heimensenwealth.com or give us a call at 712-472-3867. Don't forget to click the follow button below to be notified when new episodes become available. Securities offered through Securities America, Inc., member FINRA SIPC. Advisory services offered through Securities America Advisors, Inc. Heimensen Wealth Advisors and Securities America are separate entities.